IVM.
Folks, welcome to Paisa Vaisa. I'm your host Anupam Gupta, B50 on Twitter, and as you can see, I am really activated because today's episode is going to be a lot of fun, a lot of myth busting. My guest, Vijai Mantri, co-founder, Chief Investment Strategist at JRL Money. We are going to talk about a lot of things, including myth busting, the whole active versus passive debate. Folks, you really want to listen into this one. There's a lot of data, a lot of nuance, a lot of subtleties that probably you haven't heard of, and you really want to hear. So we'll be right back right after this short break.
What is the workplace and how does your gender and body affect your right at work? Hey, I'm Priya Mirza, and on the Longest Constitution podcast, we critically examine the vision of the Indian Constitution and laws. In season 1, we looked at sex, gender, sexuality in India, and the landmark judgments which transformed our rights as citizens in this country. In season 2, we discussed the laws which shape the workplace and examine how ability, competence, and merit impact us, and much more. Join me, Priya Mirza, every Wednesday only on the IVM podcast app, website, and all the major podcast streaming platforms.
And welcome back. First, let me introduce Vijay because he is a veteran. He spent the last 25 years in capital markets and mutual funds, from Aditya Birla Group to HDFC Mutual Fund to Deutsche Mutual Fund. He was in fact also the CEO MD of Pramerica Mutual Fund, and currently he is a co-founder and chief investment strategist at JRL Money. He's very visible on media, writes tons of columns, and I read some of his LinkedIn posts and thought I should invite him over and do an episode. And before I forget, of course, big thank you to Ashish Somaya for introducing us. Vijay, welcome to Paisa Vaisa. Thank you so much. Thank you so much for doing this for our listeners.
Thank you very much for calling me. It's really a great honor for me to be with a person like you who has been a celebrated author, one of the best-selling co-author of a book. So it's really an honor for me to be here.
Thank you. Come on, the honor is all mine. Okay, before we start, Vijay, tell us about JRL Money and also about Jeevantika, because there are two things that you do. You are the co-founder at JRL Money. So first, let's talk about JRL Money, and then I want to spend some time on Jeevantika because, God, that is really interesting.
So JRL Money is a fintech platform where we help existing mutual fund distributor to offer far superior product experience to their clients. So perhaps we should do an episode a little later on what are the interesting offering we have. Our base is PMS and mutual fund, but within that we offer very, very interesting option to the investor where the investor meet their goals, but the journey is far more smoother than in normal course of business. So we help. So we come out of fund ratings and we have interesting strategies, and the entire thing is completely tech enabled. So you don't need to do any physical movement of things. So this is about JRL Money. Other venture which I co-founded with my colleague is Jeevantika, which is a very interesting platform. Many people are not aware that if you don't claim dividend for consecutive period of 7 years, then your shares goes to Investor Protection and Education Fund. Now, there are many organizations which currently work on information arbitrage. They will come and tell you that, hey, you have shares, but we will not tell you till you sign documents with us. We have disrupted the entire market. What we have done is that we have 15 lakh folios valuing 30,000 crore, and we have put across 200 companies, which basically cover 97% of the folios and value on Investor Protection Fund. We have put that on our website in searchable format. You just need to look at two data, your surname and the state in which you belong right now or earlier. And then whosoever is there in that characteristic searches, you will get your name. And then we help investor. They can take our services and they can go directly DIY. But we have completely disrupted the entire thing. If they take our services, there's a commercial angle to it. But we do not take anything from the investor till the shares are credited in their demat account. So they don't have to pay a single paisa to us.
I want to understand this in a layman's term. Because you said that for someone who has not claimed dividends for 7 years, okay, in today's day, of course, everything comes boom into the bank account. But we belong to an era where warrants used to come. Warrants used to either not reach your house, or if they reach your house, so it would go somewhere and you would not even know it. So unclaimed dividends actually is a very big number. So talk to us about unclaimed dividend and also the more trickier part, the shares.
So unclaimed dividend, unclaimed dividend is very small portion compared to unclaimed value of the shares. So it is just not that I think most of these are pre-2000. And at that time, the value was negligible. People might have ignored it. The company might be not doing well. And suddenly, in last 25, 30 years, the company started doing well. Earlier, people used to, you are Anupam Gupta. So you wrote in, perhaps you had a sharing name of Anupam Kumar or some different name. We didn't have Aadhaar card or PAN card at that time.
Yeah.
So, and people used to apply in multiple names to get allotment. And then your bonus and dividend, rights issues and all that. So the value is actually just moved very significantly. So the second part is, which is much more interesting, is that if you sold shares, so it is not in your books of account, but you sold those shares, but the person to whom you sold those shares has not sent these shares for transfer. So in company's record, you are the only shareholders and you are the only person who's legally entitled to claim those shares. So many people are not even aware about. So it may be the ignorance, it may be a lack of information, whatever you call it. But today, currently 30,000 crore value of shares are there in Investor Protection Fund. And it looks like these shares belong to unknown names. You'll be surprised. Many known names who come in the market, their shares are there in Investor Protection Fund. Yeah.
Wow.
You forgot, you kept somewhere else in the suitcase, somewhere in the almaris, and then what has happened, don't know. So there's one part of it. Equally bigger part is you have close to 30 lakh folios, valuing close to 70,000 crore worth shares in physical form.
Oh.
And now the regulator is nudging you, get these shares dematerialized, else these shares will be frozen. So we also provide that service to the people. And there again, there's a complication. You are Anupam Gupta, but old shares are name of Anupam Kumar.
Yeah.
Married, unmarried, pre-marriage.
Yeah.
People die.
Change of address. Whatever.
Change of address. Different complications. We help investor to navigate through all that. And now we are getting more and more people coming to us because we offer in very transparent way. We don't charge anything from the investor and we have very standard charges. So it is not that I'll charge something from you and something else from somebody else. Yeah. And we don't charge anything till you get the shares in your name. And luckily, I'm being there, so there's some credibility to the whole setup.
Yeah. So folks, the website is Jeevantika. That's JEEVANTIKA. I would urge you to check that out in case you've suddenly found some share certificates of someone like a Reliance, which has kept on having so many capital issues in the last 20-30 years. And
interestingly, largest number of folios are in Reliance Industries.
Would be, na, sir. 1977 ka IPO hai, uske baad to God Lord knows. Anyway, we should do one more. And talking about credibility, Vijay, 25 years in the mutual fund industry. And look at the names here. Aditya Birla Group, HDFC Mutual Fund, Deutsche Mutual Fund, Pramerica Mutual Fund. I mean, you saw back in the 90s how the mutual fund industry started all the way till today, 2022. Tell us about that. I mean,
so interestingly, the company Birla Sun Life Asset Management Company was bought by me from someone else and then converted into Birla. At that time, we were at Nirman Point, Saviot office at Mittal Court. So I used to go every day to meet them. And we used to get a lot of regulation from Capital International, our joint venture partner of regulation in US. Helped regulate at that time. So I was part of the startup team at that time. And I was also part of the startup team at HDFC Mutual Fund in year 2000. Part of the team which revived the Deutsche Mutual Fund as a CEO. And then I got Prudential of US in India, which is Pramerica and now known as PGIM. So it has been a very fascinating journey. A lot of people don't know that total asset under management with private sector mutual fund in March 1919 was less than 7,000 crore. So the mutual fund industry has seen, among all the sector of the Indian economy, one of the consistent, fastest growth of 20% compounded over the last 25 years. Is incredible.
Wow.
And still we haven't gone anywhere.
Yeah. I mean, look at the number of folios or whatever.
Nothing. Folio. If I look at total SIPs which are more than 5 year old, the total value is just 1,11,000 crore rupees, which is minuscule.
$15 billion. That's it.
Nothing. And you look at insurance, bank FD 49 lakh crore.
Okay.
Insurance 38 lakh crore. If you look at the numbers, and we are nowhere, and we can discuss more about this.
Yeah, like you said, many more episodes. Finally, Vijay, before we go into the break, you ran a fintech company. You know how fintechs run. You've seen in the last 4-5 years how so much of money has poured into this space. All of them want to jump on mutual funds, investment, shares, advice, X, Y, Z. What's your view? Because these people, unlike, companies of our era where you would have a promoter who would do a business, he would have cash flows, he would have profits, he would go to maybe a bank to get a loan. That model is disrupted. But if you talk about fintechs in the space of investments, what's your view on that? How the space has, shaped out so far, and going forward, what do you think is going to happen?
So there's some guy who's done an incredible job. Perhaps they rode on the back of what has been created by mutual fund distributor and mutual fund industry. So why Virat is a great batsman? Because he rode on the shoulder of Sachin, and Sachin is great because he rode on the shoulder of Sunil Gavaskar. So if you look at the mutual fund industry, if you look at SIP numbers, so they are named like HDFC, SBI, we did like few lakhs SIP. Grow does 50 lakh SIP. Now, these organizations are 25 into the mutual fund industry. Grow is maybe 3-4 years. So it is a technology which is helping. This is one part. The second part, many fintech offer direct plan where they don't make money in the process. And I think is a customer acquisition tool, in my opinion. I am not privy to their business plan, but why you want to acquire a customer if the customer is not profitable to you? And no mutual fund investor per se can be profitable if you offer direct plan to them. So invariably, these customer comes and then you have a stockbroking and other alternate product being sold out. The way we set up our fintech platform is that we are not looking at market share. First, we need to have a great product, great track record, and then you build over on that. So we also have a lure of people coming and telling us we want to give you funding, grow your business. We are holding it back.
Interesting. We should have you back to explain that once that is out. So folks, we will be right back after the break, where we're going to talk about some pretty interesting stuff on index funds, passive investing, active investing. So don't go anywhere. This is going to be a really interesting episode. We'll be right back.
Hello. It's been another great week here on the IVM Podcasts Network. On Cyrus Says Cock and Bull, Cyrus, Naveen, Utsav and Abbas discuss how COVID cases are on the rise in Mumbai. Introducing our new show, Intel vPro presents Future Proofing with Eklavya Bhattacharya, your one-stop shop for all things Web3, blockchain, metaverse, and so much more. In the first episode, Eklavya talks to Advertising is Dead host Varun Dugirala about advertising on the web. On Simplified, Chuck, Shriketh, and Tony discuss why we aren't excited about smartphones anymore. On Paisa Vaisa, Anupam and Atul Suri, CEO at Marathon Trends, talk about trend investing principles. On Smarter with Sid, Siddharth explains the 3 pillars of content creation. And on All Things Policy, the Takshashila folk analyze the Lancet Commission report on financing primary healthcare. We've got some exciting news for you. IVM Podcasts has just launched its merch, and our first line is out now. Head to the IVM Podcasts website and click on the Shop tab to check out our first collection of t-shirts. Do follow us on social media. We are IVM Podcasts on Twitter, Facebook, Instagram, and LinkedIn. And remember, if you're enjoying this show or any of our other shows for that matter, please do tell a friend. Also, don't forget to rate us on any platforms you're listening on. And you can also check us out on YouTube. We're also doing a small listener survey to better understand how you respond to our shows and advertising on the network. We would really appreciate it if you could spare a few minutes to fill it in. It helps us build better shows for you. And finally, we would like to thank our sponsors this week. SBI Life Insurance, Apne Liye, Apno Ke Liye. Jupiter, a digital banking app. Capgemini, get the future you want. Intel vPro, built for business. And Intel, future banao wonderful with Intel-powered laptops.
And welcome back. Okay, Vijay, now let's get into the hairy stuff, the unconventional stuff. Over the past few years, index funds and passive investing have taken over all conversations. So I've done quite a few episodes on them. So I'm going to start there. Conceptually, okay, let's just talk about concepts. We'll get to the data later. What's your own individual personal take on this debate, active investing versus passive investing?
See, I think both the idea will exist and should coexist. There's absolutely no problem in that. But the way today the idea has been communicated is that actives are bad, just come to the passive. That is also fine, but at least you should show full facts to the investor, which actually none of these reports comes out with. I challenge them many times, but none of them show actual data to the client. So, for instance, there's a headline grabbing news that 80% of the fund underperformed TRI. God knows from where they get the data. It is true that in some period, the large cap has underperformed the TRI. But in the mid and small cap category, in the ELSS category, in the others category where your contra dividend yield focused value fund, there are large number of funds where the outperformance is consistent and very significant. But just hold that for a moment. When you say active fund underperform, they underperform what? they underperform against TRI. Okay, so we are underperforming against TRI. So what should investor do? Invest in TRI. How does investor invest in TRI? Either you go through ETF and either you go through index fund. ETF, they got their own challenges in India because of buy and sell spread, which is very huge. So the only alternate available to look for you is to look at index fund. So the right comparison, in my opinion, of actively managed fund has to happen first with the index fund. Second thing, index fund comes at very low charges. So perhaps no mutual fund distributors are interested in selling them. So the customer need to pick them directly. If that is the logic, then the direct plan of mutual fund need to be compared with index fund direct plan. Right now, what is happening that a fully loaded plan of actively managed fund is compared against TRI. I don't know whether it is being done deliberately or it is by default. I don't know. I have done my own numbers. And when you compare with index fund, the data looks very, very different even for the large cap.
Let's get into that, right? Because I saw your LinkedIn post and you said that first of all, of course, all index funds underperform the underlying index, and you're not the only one saying that. I have spoken to a few veterans of the industry who also share the same view that first, all index funds underperform the underlying index, even if by less than 1% per year.
No, it is not 1%. Okay, they consistently underperform more than 1%.
So let's get into that.
So if you look at data for 1 year, so forget about 20-25 years, because at that time, perhaps the number of index fund was not very large. So if you look at 1 year, 3 year, 5 year, 10 year, 15 years, okay? Now you'll find two interesting things. One is that within index fund, in same category, for instance, Nifty 50, there's a huge gap between the best and worst. Over a 15-year period is more than 1% compounded. So in absolute term, it is 19% gap between the best index fund and the worst index fund.
And the index fund you're saying?
In the only Nifty 50 index fund I'm talking right now. Okay. Over a 5 year, the gap is as high as 7% in absolute term. So the gap between the best and worst is actually 1%. So someone saying you that index fund is easy, you don't need to apply your brain. Then the question comes, first of all, within the index fund, even within the Nifty 50, which one you pick.
Oh, okay.
Second thing, most liquid is Nifty 50. Even the Nifty 50, consistently, there's a 1% plus kind of underperformance. Consistently. It is not, we are talking about some illiquid indices. We are talking about liquid indices. So there's a consistent underperformance. And the reason is, one is their charges, then there's impact cost, and then there's a brokerages, security transaction tax, stamp duty. They need to hold some cash. There's a continuous buying and selling happen in index fund. Combination of all these create inefficiency in index fund. So that, in my opinion, is a big mystery which has not been disclosed to investor, that index fund underperform. There's a possibility of actively managed fund outperforming 20%, 30%, whatever number you take. There's a one part. The second part is when you invest in index fund, the question is which index? Nifty 50, Next 50, 100, 200, 500. Then we talk about a small, mid. So there are more than hundreds of index fund.
Without even getting into factor.
Without getting into factor. So how do you choose which index fund you should go with? And if you look at, for instance, I looked at 500, Nifty 500. There's a Nifty 500 TRI and there's a Nifty 500 fund. That Nifty 500 fund underperforming it by 2.5%. If you go to sectoral indices, the underperformance is massive of the index fund of that sector.
Okay.
So it's very interesting. But you just take a pop-up window of one particular period. Please, when I say please disclose this fact to the investor, I don't have any problem. Anybody investing in index fund is a great idea. But who's going to help investor to choose which index fund? Okay. So to me, these guys are not disclosing these things. So I don't know what is the rationale behind it.
Yeah. So folks, I'm going to just, leave that thought with you that when you're choosing an index fund, at least be careful. Because from what Vijay is saying, the idea that I'm getting is if even with an index fund, there's a massive...
So you have equal index, your momentum index fund has come into market. So you have low volatility, alpha. Now in ETF, the gap is so high. So right now, just few days back, ET Prime carried a story of Kotak Alpha 50. I don't know whether you tracked it or not.
No, I missed it. Yeah.
So it is a Alpha 50 Nifty ETF. Now what has happened on March 31st? 2 stock went out and 2 stock came in. Now this 2 stock which came in, one stock had a weightage of 10%, other stock had weightage of 6%, 16%. But these two stocks were hitting upper circuit, so the fund could not buy it. So they were sitting on 16% cash.
That's going to hit your performance.
That is hitting. That is visible. If you look at momentum investing, where UTI got a momentum fund index, that is having a tracking error of 3%.
Huh?
Yeah.
Wow.
Consistently.
Pretty high.
So investor need to be aware about these things. Okay.
Yeah.
And ETF, you look at any day, is very funny thing in ETF. Suppose you look at, again, forget about, just look at Nifty ETF. Go to Money Control and see Nifty ETF prices. Suppose today market is up 1%. You will find some ETF down, some ETF up more than 1%.
That's wild. Doesn't make...
I'm talking about Nifty.
Yeah, I know.
But forget about small mid cap where
there's no liquidity.
There's no liquidity.
This is the most liquid index in India.
Absolutely. So what has happened is that from 2015 to prior to 2015, there was a huge outperformance. 2015 to 2020 is an period in which we have seen underperformance by large cap. It is more structural in nature than the ability of fund manager, and I'll explain you why. Because from 2015 to 2020, more than 80% of Nifty performance came from top 5 stocks.
For 5 years, 80% performance in the Nifty came from just
top 5 stocks.
Wow.
Now, as a mutual fund, you can't own more than 10% in a single stock. So what do? Suppose Reliance is doing very well. Reliance weightage is 13-14%. You can't own more than 10% in Reliance Industries. So post 2020, we have witnessed when the economic recovery become much more broad-based, I think you see outperformance coming back into mutual fund industry.
And that 5-year gap is going to obviously have some weightage whenever you look at longer term performance because of these things.
Yeah.
Wow, folks, I hope that was useful to you. Simple takeaway, just choose your index fund carefully. And a couple of other things I'll tell you. Huh?
When they compare index fund, they don't give asset weightages. So suppose there's a HDFC flexi cap of 30,000 crore and their ITI large cap fund of 100 crore. They're in the same bracket.
Even though there's 100 crores AUM and 30,000 crores AUM.
Yeah. So if HDFC outperform by 1% and ITI underperform by 1%, it is 50-50% weightage. Suppose there are only 2 fund in that particular category. There is one part one need to keep in mind. Second part, which again is very important, is that suppose I'm investing in Nifty 50. Now my fortunes are linked to Nifty 50. In actively managed fund, I can give to my investor 2 contrasting style. So suppose I believe S. Naren of ICICI and Prashant Jain of HDFC Mutual Fund are value investor, I would give part of the portfolio in the value investing. And I believe Axis and other fund houses are more growth oriented. I give contradictory style of investing to my investor, which is not possible to be done in indexing. And one more interesting aspect, which we are completely ignoring, which will have a huge repercussion as we go along, is this. Suppose like what happened in US, where passive become the biggest shareholder in the indices. What does passive do when the voting of a particular item in a company comes? How do they decide how should they vote?
Oh, that's a big one. Yeah, no, people haven't thought about
this. People haven't thought about it, but
India,
it is a challenge.
It's a big challenge.
Yeah,
because logically you're talking about ownership lying with a very select group of people, and that's playing out in the US. A whole stakeholder, shareholder debate,
and they're not supposed to vote.
They're not supposed to vote. That's really going to be good fun.
Okay,
Vijay, let's get into the active part, right? Because your data, what you posted on LinkedIn, and I'll just say that to our listeners out there, it says that data shows that on a 20-year period, only 20% of active funds, okay, that's 40 schemes with a minimum 20-year history. Folks, that's important. Minimum 20-year history, just 20% have underperformed the index. Okay, this is, like I said, this is counter to what narrative
absolutely
is.
And it is interesting to see who underperform. It is LIC, JM and Taurus.
Just 3 funds.
Exactly. And you have one HDFC large and mid-cap fund, which was earlier Morgan Stanley fund.
The old one. Okay.
Yeah, so it ran a close-ended fund from 1994 till 15 year till 2009. And then it became open-ended, and then later on HDFC.
The original fund for which people were standing in a line
in 1994.
Yes.
Same one. So it is now HDFC large and mid-cap fund. So when you look at the performance of that fund, largely it is the Morgan Stanley performance. It was a close-ended fund. And you have JM and you have Taurus and you have LIC kind of fund, where if you look at effectively the AUM managed by these funds are not even 1% of the industry AUM, but they are there as a one item, so you need to give them weightage. But if you look at asset weightage, even today, more than 2/3 of the large cap fund outperform indices.
That's that's contrary, man. It's
Yeah,
just so
because
totally
nobody want to see the data and the reason is very simple that the mutual fund industries and MFD has created a huge ecosystem of investor base. How do I go and get these investors very easily? So if you want...
This is your data. Explain how you got it, right? We don't know how the other side got it. Like you said, we don't know.
No, I thought just look at, I can show you the data. Just go to the SMF, I have a software. You can download the data, whichever period you want to download.
And whatever. So you've just done price performance, that's it.
Absolutely. Nothing else is to be done.
So you've compared the price performance of only those schemes which are 20 years plus.
I did for 20 years, I did for 25 years, I did for 15 years, 10 years, 5, 10.
And all of them same?
Yeah. So for instance, in 5-year period, the active underperformance is 92%. So in 5-year period. So
92% of active mutual funds underperform. So on 5-year basis that...
Yeah, because as I told you, from 2015 to 2020 was a period where 80% plus gain came from only top 5 stocks.
Okay. So because of that, the 5-year data might give you that impression. But
absolutely.
Once you expand the screen, you zoom out and you look at a longer time frame.
I think it is more structural in nature, because suppose Reliance did fantastically well during that period and the weightage become 14-15%. You can't own more than 8 to 10 effectively. It is just not even 10%. Lots of active fund manager don't understand Reliance. I haven't met anybody in the capital market who say, I understand this company.
That's okay.
So interestingly, it is not in the top holding of many funds. Though it is the number. It is under-owned because nobody understands it. Yeah. So if that stock does well, what do? You will underperform.
I think the FIs have it in a bigger way than the
FI would have in domestic.
That's amazing. So the largest weightage stock of the Nifty is under-owned by the largest large cap funds in India.
It has to, because first of all, if it weightage is 13%, you can't go more than 10%. How many fund manager in this country understand that balance sheet? You ask them, they will tell you. Yeah. You don't need to ask them. Look at the fact sheet. You get the answer.
It's a 300 page plus annual report. I don't know how many subsidies it's got. So you're saying that one is a structural thing, which is that 10% limit will hit all fund managers. Even if they want, they can't.
Yeah, suppose now the HDFC and HDFC Bank is getting merged. The combined holding could be more than 10% because the free float is highest. Yeah. So then again, you will have some problem.
Is there something for the regulator to figure out? Because it's a structural issue which is hurting active funds for no fault of theirs.
I think it is. And interestingly, in the sectoral fund, these caps doesn't apply.
But sectoral funds ka weightage matlab,
Yeah, but suppose in pharma, banking, there are fund where people would like to participate. There in those, the sectoral weightage doesn't apply. But in actively managed fund, the sectoral weightage do apply. So what regulator can do and should do, in my opinion, that you can go up to maximum of the weightage in the indices in a particular stock. Even it is breaking the 10% limit. I think that is something which regulator I need to, but I don't think anybody is pushing right now because it is Reliance. Yeah. Suppose now when HDFC and HDFC Bank get merged and then they would be urged to own these stocks. So perhaps at that time the need will arise and then people would think what we need to do.
Or Reliance does demerger? Who knows? We're not here to speculate. We're not here to speculate that. Vijay, I just realized one more thing, that one argument that comes from the industry is that you had that reclassification of schemes, I think 2-3 years ago, and because of that...
2018.
2018. So it's been about 4 years. So that maybe that also caused some kind of... I won't say polluting the data, but kind of it affects the data when you look at active versus passive.
It does affect the data. And second thing it affects the data is that you just put 5 years, 7 years number and say underperformance. Underperformance against what? Somebody had a Sensex as a benchmark. Somebody is a Nifty 50. Somebody is a Nifty 100. You pick one benchmark and then you put everything around that. Everybody has to go by that benchmark. I was not following that benchmark 3 years back, 5 years back. So why are you punishing me? I've underperformed. And as you know that within the benchmark, there are variance in performance. So in one particular period, Sensex did very well. In one particular period, Nifty did very well. But so it just one mistake. But I think now regulator is saying for all large cap fund, let's have Nifty 100 as a benchmark. So going forward, it will be much more interesting to see. One more interesting aspect is that the way passive funds are picked up, it is, for instance, just look at Nifty 50. Top 50 free float market cap companies are picked up. Now that company could be anybody. So for instance, if you look at Nifty as a fund manager, Nifty since its inception made 186 positions. It made money in 86. So it made money in 56% of the position and 44% of the position Nifty lost money.
Dheeraj, just 1 minute. Let me get this right. You're saying that Nifty from inception, which is 95 to 2020,
180 plus.
they made 186 changes, which is plus minus.
Plus
okay,
minus.
186 came in, 186 went out. Out of that,
They made money in 82 plus, around 56%.
when you say money, it means that the entrants who came in actually returned
made
positive share.
before they exited, or they're still there.
And the
44. Now, just
it's a
here.
coin toss, yeah. It's almost like a coin toss.
So there's a one part. Now, just hear me out. If you're a fund manager who bought Unitech, DLF, JP Associate, J Corporation, Reliance Communication, Reliance Capital, Reliance Infra, Reliance Power, these gems before they got Asian Paints in their portfolio, what do you look at that fund manager?
If it was 2007, I would have called him a genius. But I'm sitting here 15 years later and I have the very big benefit of hindsight. Back then, come on, Vijay, these stocks were, you couldn't ignore them.
Exactly. So that is the point. It is by design or just happened. It is a structural thing. Okay. So one more thing I'll tell you.
Asian Paints came in just 2012.
Asian Paint came into Nifty in 2012 only.
I didn't know that. Okay.
So it's very, and now look at irony of the situation. Yes Bank, RBI came with its irregulatory report on 21st September 2018. It was part of Nifty. The stock went down 29% on that day and closed at 226 rupees. But it exited Nifty in March 2020 when it hit 54 rupees.
1.5 years.
So from 226 rupees down to 54 rupees, there were only two set of investor buying Yes Bank. One was passive in Nifty fund. Second is retail investor.
So the retail investor and index fund invested in Yes Bank after the bad news came out.
226 to 54 rupees.
वो सब loss अपने जेब में.
तो करना ही पड़ेगा because that was, you were in top 50, so you have to buy it. Suppose index fund is getting money, they're getting SI inflow, so what will you do? You'll buy that only.
It's crazy.
So I'm saying these are structural changes, and couple of other aspects people need to keep in mind. When we compare US market and say this thing has worked in US, so it will work in India, not necessarily it is true. So for instance, what is good for Wall Street may not be a great idea for other part of the world. So for instance, most of the theory in economy and finance come from Wall Street, US universities, because they drive the agenda. For instance, interest rate. The falling interest rate is great for economy. India is a country of savers. Is that great for them? Ask a poor retiree, he will tell you. Throughout his life, he lived in 8% inflation. His retirement age come and you say, we have to become globally competitive. So FD will get 5%. Go and tell.
You should put that money in the stock market.
Exactly.
Wow.
So who will put the money in stock market? And in India, debt market means FD. It is not the bond fund. So unlike US where the interest rate went down, you had a huge capital gain. You didn't have that situation in India. So you have to think how India work and how Indians work. So I give one very interesting illustration. In India, not a single brand of any product dominate in any category. You could have 5%, 6%. Unlike US where there are two political parties, two cola drink or one breakfast. In India, nothing like it. And one of the biggest idea which is ever marketed to humanity is religion. And I tell you something very interesting about it. If you look at the Western world, if you are believed in Christianity, there's a one God, Jesus. If you believed in Islam, there's a one God, Allah. So they had 100% market share. In India, we have Hindus, Jains have one god. Hinduism, which is like 80% of the population, I don't think a single god have more than 3-4% market share. So we are a very different country.
Market share. Okay, we've never done religion on this show, but thanks Vijay for that. Okay, to wrap this up, Vijay, you're a big believer in active equity mutual. I mean, you can understand it because you've come from the industry, you've stayed there, you've seen. I'm sure you know a lot of the fund managers. What if, a lot of our listeners out there just want this very simple advice? Let's say they're going out to invest in an active fund. Okay, we already covered index and we've shown how that can be a tough decision. How should they go about choosing an active mutual fund?
So I think I would answer them that first of all, they need to have a good financial advisor working with. It is very, very important. For everything, don't go DIY. I meet many investors that tell me we just select a stock directly, we select mutual fund directly, we do this direct. I said for all of them, there's outsourced service available with demonstrable track record of 20-25 is why you need to break your head. And I look at that person, I said, you need to reduce 15 kg weight. This is something which you can't outsource. Your family need time. Your spouse is saying you don't spend time. Your colleagues are telling you don't spend time. Your siblings are telling, your parents are telling you don't spend time because you don't have time. These things cannot be outsourced. So get your priority clear. Your health is number one priority. We are living in obesity. We are living with lifestyle diseases. What is far more dangerous for you? And I tell you, by going through a financial advisor, I can create more wealth even in the full brokered plan. For instance, one of the biggest thing you can create in investing is longevity. Suppose you work out daily 1 hour rather than spending time and figuring out which stock to buy. You will live 85 years instead of 80 years. And last 5 years, whatever you created, double in 85th year. So if you understand mathematics, understand this very clearly. There's a one part. You should have a good financial advisor. Second thing is that there are certain things, as we explain, which can be outsourced, should be outsourced to somebody. The third thing is that don't go by rating, and perhaps we'll do a separate show on the rating where I looked at the best rated fund and how they perform in future.
Okay.
It's very interesting thing. So, but my opinion is that go with your well-chosen financial advisor, because you can question them. You can't question index fund. Diversified across 7-8 fund houses, and assume that 2 fund will be great, 2 fund will be lousy, 4 fund will be okay. But on an average, in a 20-year period, the worst performed mutual fund delivered you 12% return. Just go with that mindset. It will beat anybody else. So don't focus too much on beating the market. First, focus on meeting the market.
Wow. In a 20-year period, the worst active equity mutual fund still gave you 12% CAGR.
12% CAGR. Just focus. Assume that you're going to get worst only. You're going to get worst only. Just go with that.
You need your own podcast, my friend. You should really look at doing that. I think the good folks here at IVM can help you with that. And folks, that is a wrap on this really fun-filled episode of Paisa Vaisa. My guest, Vijai Mantri, co-founder and Chief Investment Strategist at JRL Money. The website is JRL Money. And like I said, you should also check out Jeevantika. If you suddenly found a bunch of share certificates,
reach out to us.
Reach out to Jeevantika and they will help you out in this. Vijay, really, thank you so much for doing this for our listeners.
Pleasure, Anupam. Pleasure, really.
Thank you. And folks, if you like this podcast, don't forget to check out other interesting podcasts on the IVM network. You can listen to us on the IVM Podcast app or ivmpodcast.com. You can also follow us on our social media. We are IVM Podcast on Twitter and Instagram. And if you want to reach out to me, I'm your host, Anupam Gupta, B50 on Twitter. Folks, thank you. Really, thank you so much for listening to Paisa Vaisa.
No material on the show should be considered as financial advice. The material on the show is for informational purposes only. Please consult a financial advisor before taking any investment decision.
Have you ever wondered where the business world is headed? How the ways in which we create, market and sell to consumers will evolve? Or if we'll ever go back to wearing pants while working? For answers to all of this and more, tune into Advertising is Dead with me, Varun Dugirala. Every Tuesday, as I talk to entrepreneurs, leaders and change makers from across business, media, marketing and beyond. You can catch all episodes of Advertising is Dead on the IVM Podcast website, app or wherever you get your podcast from.
There's a quick survey to fill out on ivmpodcast.com/survey. It lets us know a little bit more about who's listening to us. And you know what? We're going to do a few prizes. So, we'll do a random drawing of maybe 10 people and we'll send you all some swag. Remember, that's ivmpodcast.com/survey where you can fill out this survey.